What if I told you that one of the single most important artificial intelligence hardware companies on the entire planet just crashed a stomach churning 40%, and at the exact same moment, the smartest, best paid analysts on Wall Street responded by aggressively doubling their price targets? Not trimming, not holding steady, doubling. Think about how strange that is for just a second. The market is screaming, sell, get out, run for the hills, while the professionals whose entire careers depend on being right are quietly backing up the truck and buying. So which side is telling the truth? Is this a catastrophic bust in the making? Or is this the kind of once-in-a-decade discount that people brag about for the rest of their lives? Today, we are pulling apart the absolutely wild ride of SanDisk, and we are going to answer the big question sitting behind that 40% crash and those doubled price targets. We're going to explore why there is a massive multi-billion-dollar disconnect between what the market is actually doing and what the underlying fundamentals are quietly saying. And most importantly, we're going to break down exactly how you can understand and position yourself for what happens next. By the end of this, you'll know more about this situation than 99% of the people currently trading it. If you find this breakdown valuable, do me one quick favor and hit that like button and consider subscribing so you don't miss the follow-up when this story inevitably explodes. It genuinely helps the channel more than you know. All right, let's get into it. But here's the thing. To understand where this stock could possibly be heading, we first have to sit down and truly appreciate the sheer jaw-dropping violence of where it has already been. Because this is not a normal stock chart. Take a good, long look at this setup, because it is genuinely one of the most extreme situations in the market right now. SanDisk, even after this brutal drop, is still up an eye-watering 487% year-to-date. Read that number again. Nearly 500% in a single year. If you had gotten in early, you'd be sitting on life-changing gains. But if you bought in recently near the top, you are absolutely feeling the pain right now, and I completely understand why. The stock rocketed all the way up to an all-time high of $2,354 in late June. And since that peak, it has suffered a savage 30% to 40% haircut. Now here is the part that should make you lean in a little closer. This enormous valuation compression, this violent drop, is being driven almost entirely by a broader artificial intelligence chip sector sell-off. It is not being driven by anything that went wrong inside the company itself. Let me say that clearly because it matters. The underlying internal business fundamentals, they have not changed at all, not one bit. The company is doing exactly what it was doing when the stock was 40% higher. So doesn't that immediately make you wonder, if nothing actually broke, then why did the price break so hard? And while these growth numbers look absolutely incredible on the surface, there is one hidden metric buried in here that changes almost everything. And we'll get to that in just a moment. Trust me, you'll want to see it. If we dig a little deeper into the actual numbers printing on the tape right now, the wild volatility we're seeing starts to make a whole lot more sense. At this moment, SanDisk is hovering somewhere in the $1,599 to $1,617 range. So it's found a temporary resting place after the fall. But the single metric you really need to pay attention to here is its beta. And right now that beta is sitting at an elevated 3.78. What on earth does that actually mean for you in plain English? It means SanDisk is behaving as though it is almost 4 times as volatile as the broader market. 4 times. So when the market twitches, this stock convulses. When the market dips, this stock plummets. And when the market rallies, this stock can rip higher with terrifying speed. The critical takeaway is this. SanDisk is currently swinging violently on macro news that has, in many cases, absolutely nothing to do with memory chips at all. It has essentially transformed into a hypersensitive proxy, a kind of emotional lightning rod for the entire artificial intelligence sector. When traders feel good about AI, they buy SanDisk. When they feel scared about AI, they dump SanDisk. The stock's own excellent business is almost an afterthought in the day-to-day price action. And that right there is a recipe for the kind of chaos we're witnessing. But that's honestly only half of the story. Because the moment you compare the market's raw emotional reaction to Wall Street's cold, calculated reaction, you get 2 completely different realities staring back at you. We are looking at what I can only describe as a total split personality in the market right now. On one side, you have the tape, the actual daily trading, which is pricing in an immediate cyclical peak. Investors are dumping shares aggressively, treating SanDisk exactly like a traditional commodity business at the top of a boom about to go bust. That's the fear side. But then you look over at Wall Street, at the professional analyst community, and it's like they're watching a completely different movie. They haven't made a single cut to their outlook. Not one downgrade in the face of this drop. In fact, it's the opposite. Firms like Evercore are literally doubling their price targets. Evercore raised its SanDisk target from $1,400 all the way up to $3,100. Let that sink in. The stock crashes, and the response from a major firm is to say it's worth roughly double the previous target. Why would they possibly do that? Because these analysts are now modeling this business like a recurring revenue software as a service company, completely ignoring the traditional boom and bust cycle that has historically defined memory chips. They believe something fundamental has changed. So who is right here? The panicking market or the confident professionals? Well, the answer is going to be revealed on two very specific dates, and they are coming up fast. So mark your calendars right now, because August 5th is the absolute center of gravity for this entire stock. This is their fiscal fourth quarter earnings print, and honestly, I'd assign a 9% plus probability of a massive, dramatic price impact on that single day. This is not a normal earnings report. This is the moment the entire debate gets settled, at least temporarily. Everything we're talking about today funnels directly into that one announcement. And then, right on its heels, on August 13th, we have their Investor Day, which carries a medium to high probability of moving the needle even further as management lays out its longer-term vision. Two dates. Enormous consequences. The countdown is already on. Now, to truly understand just how explosive this August 5th date is going to be, we have to look at what the options market is quietly telling us behind the scenes. And what it's telling us is genuinely a little scary. The expectations heading into this earnings print are already sky high. Management has guided for $7.75 billion to $8.25 billion in revenue, alongside a truly enormous $30 to $33 in earnings per share. Those are big, bold numbers. But here's where it gets fascinating. The options market is actively pricing in a massive binary price dislocation. Implied volatility is currently sitting at 124%, which places it in the 98th percentile of its entire one-year history. Do you understand what that means? It means the market has almost never been this braced for a violent move in this stock. The professionals who trade options for a living are literally positioning for an earthquake. They don't know which direction it's going to shake, but they are absolutely certain the ground is about to move. Doesn't that make you wonder what they know that everyone else doesn't? Now, none of this really matters, none of it makes sense, until we understand precisely why the analysts are so incredibly confident despite the crash. And it all comes down to one thing: a massive multi-billion-dollar shield. This right here is Wall Street's holy grail for SanDisk. It's their new business model, which insiders simply call the NBM. And here's the headline that should stop you cold. Management has locked in a staggering $41.6 billion backlog in long-term supply contracts. $41.6 billion. This is heavily focused on their Stargate Enterprise solid-state drive line, which is exactly the kind of high-end storage that powers the enormous artificial intelligence data centers being built out across the world right now. The entire bullish thesis, the whole reason analysts are doubling their targets, rests on one single powerful idea. It's the idea that these multi-year contracts will insulate the company from future drops in NAND spot prices. In other words, even if the price of memory chips falls off a cliff in the open market, SanDisk has already locked in its buyers at agreed-upon terms for years to come. They are essentially trying to legislate away the commodity cycle. They're attempting something the memory industry has arguably never truly pulled off before, and if they succeed, the reward is enormous. But can they actually do it? Hold that thought. Because even a $41 billion shield can't fully protect you from the broader economic weather rolling in overhead. We are currently dealing with two massive macro overhangs pressing down on this stock. The first is hyperscaler capital expenditure sustainability. That's a mouthful, so let me simplify it. SanDisk trades instantly on read-throughs from big technology companies. If a giant like Alphabet or Intel so much as hints at any slowdown in cloud spending, SanDisk gets punished almost immediately, regardless of its own contracts. It's guilt by association. The second overhang is geopolitical. Escalating tensions on the world stage are forcing the broader market into a defensive, risk-off posture, and that environment is absolutely brutal for high-beta, high-flying technology names exactly like this one. When investors get scared globally, the first stocks they abandon are the volatile ones. And with that beta of 3.78 we talked about earlier, SanDisk is right at the top of that list. And yet, despite all of these very real risks swirling around, the biggest players in the game are making their moves right now in real time. If you want to know where a stock is truly heading, there's an old piece of wisdom that never goes out of style. Follow the money. So let's follow it. institutions currently own roughly 80% of all SanDisk shares. 80%. And over the last 12 months, they have been accumulating those shares at a 2-to-1 ratio, meaning far more buying than selling. So while the retail crowd is panicking over this 40% dip, the smart money at the fund level is aggressively buying it up. We just saw a Senegal Asset Management open a massive brand new $1.4 billion position. That is not the behavior of people who think this company is finished. That is the behavior of people who see a bargain. So if the professionals are this eager, doesn't it make you wonder what everyone else is missing? And believe me, the aggressive bets don't stop at simply buying shares. They get far more sophisticated and far more revealing. Take a close look at this recent options activity because it tells a powerful story. An institution recently dropped $57 million on what's called a bullish risk reversal. Now that sounds complicated, but the logic behind it is beautifully simple. They sold 2,000 October $840 puts, and they used the money from that sale to directly subsidize buying 1,000 October $1,520 calls. So what does that actually mean in plain terms? It means they are so supremely, almost outrageously confident that SanDisk will never drop back down into the $800 range, that they are essentially willing to bet the house on a massive upside breakout instead. They're not just hoping it goes up. They financially structured their entire position around the conviction that a crash to the 800 simply will not happen. That is an extraordinary level of confidence. But is it justified? But wait. Here's where the story takes a genuinely unsettling turn. Because if the institutional thesis is truly this bulletproof, if the smart money is this sure of itself, then why on earth are the people working inside the company doing the exact opposite? Here it is. This is the massive red flag I promised you earlier, and it's a big one. Over the last 6 months, company insiders have made 0 purchases. 0. Not a single one of them has bought a single share with their own money. Meanwhile, during that very same period, executives have executed 7 massive sales, unloading over $10 million worth of stock. So think about the picture this paints. On the outside, you have Wall Street firms doubling their targets and institutions pouring in billions. On the inside, you have the executives who know this business better than anyone quietly heading for the exits. It begs the obvious, uncomfortable question. If these lofty Wall Street price targets are truly as guaranteed as everyone claims, then why are the insiders, the very people with the best possible view of the future, aggressively selling into the strength? What do they see that the analysts don't? Or is there a perfectly innocent explanation? This is the tension at the very heart of the entire SanDisk story. This deep conflict between insider reality and Wall Street fantasy sets up 2 dramatically different possible futures. So let's map out exactly what those look like. We are genuinely looking at a true fork in the road here, and the 2 paths could not be more different. In the best-case scenario, SanDisk comes out on August 5th and absolutely crushes their $33 earnings guidance. Artificial intelligence demand holds strong. The contracts prove their worth, and we see a violent short-covering rally as everyone who bet against the stock is forced to buy back in at once. In that world, the stock could genuinely chase those $3,000 price targets from firms like Bernstein. It would be spectacular. But the worst-case scenario is frankly terrifying for anyone holding the stock. Picture this. Competitors like SK Hynix, who are actively investing $51 billion into their own capacity, decide to flood the market with NAND supply. When supply floods in, prices roll over hard, and in a true bear cycle, those beautiful earnings could collapse. In fact, fiscal year 2027 earnings could potentially fall all the way down to $80 per share, which could drag the stock all the way down to $800. That's the exact level those confident options traders swore would never happen. So you can see why this stock is so electric right now. The gap between these 2 outcomes is enormous. Which path will it take? Nobody knows for certain yet, but the clues are everywhere if you know where to look. So while we wait for the big reveal, how on earth do we make sense of this in the immediate term? Over the next 1 to 2 weeks, leading right into that pivotal August 5th print, you should honestly expect brutal, sideways chop. The stock is currently channeled almost perfectly between $1,400 of support on the downside and $1,600 of resistance on the upside. And without any major corporate news to give it direction, it is trading entirely as a macro proxy. What does that mean for you day to day? It means you could easily see intraday swings of 5 to 10% based on nothing more than random cloud infrastructure headlines that have nothing to do with SanDisk directly. It's going to be a nerve-wracking, whipsaw waiting game right up until that earnings date arrives. Patience here is genuinely a weapon. Ultimately, when you strip away all the noise, all the charts, and all the options data, this entire situation boils down to one single, fundamental, almost philosophical question about the semiconductor industry itself. Can contracts truly defeat the physical reality of a memory chip glut? That's the question. Management is standing up and claiming that their $41 billion backlog eliminates earnings volatility once and for all. It's the classic, seductive, this time is different narrative that we hear in every hot sector. And maybe, just maybe, they're right. But let's be real with ourselves for a moment. NAND memory is, at its core, fundamentally a commodity. And history has a very stubborn habit of repeating itself. Historically, every single time competitor capacity expands significantly, like SK Hynix's brand new $51 billion push, it has eventually triggered a glut, and that glut crushes prices. So the entire bull case is essentially a bet that SanDisk has, for the first time, broken a decades-old economic law. It's a bold bet. Is it a smart one? That's what you have to decide. So after all of this, what is this stock actually worth? And what is our final verdict? Here is the big payoff, the whole thing distilled down. If SanDisk has genuinely successfully transformed itself into a protected, recurring revenue business model, then this current 40% haircut isn't a disaster at all. It represents an absolute generational entry point. In that world, you'd essentially be buying a cash printing machine at a massive, panic-driven discount that will look obvious in hindsight. But, and this is the crucial but, if history simply repeats itself the way it always has, and that incoming wave of supply triggers a traditional hardware bust, then the tape is completely accurate, the doubling analysts are dead wrong, and the market's current panic is entirely, painfully justified. Two futures, one stock, and August 5th is the day we finally start to get our answer. Now, before we wrap everything up, I need to be crystal clear with you about something important. Everything discussed in this video is for informational and educational purposes only. I am not a financial advisor, and nothing here should be taken as personalized financial, investment, or trading advice. Stocks like SanDisk, especially with a beta this extreme, carry very real risk, and you can absolutely lose money. Please always do your own thorough research and strongly consider speaking with a licensed financial professional before making any investment decision. Your money is your responsibility. With all of that said, this leaves us with a genuinely fascinating question, and I really want to hear your take on it down in the comments. Here it is. If you had money on the line today, would you trust the insiders quietly selling their shares, or the Wall Street analysts loudly doubling their targets? Who do you believe knows the real story here? Drop your answer below, and let's get a real debate going, because I read every single one. If this deep dive helped you understand the situation more clearly, please smash that like button. It genuinely helps this video reach more people who need to see it. And if you're not already subscribed, hit that button now so you're right here with me when August 5th arrives and we finally find out who was right. Thanks so much for watching.